My name is Rosa. I'm here on behalf of Follow This, your green shareholder. And my question is for the CEO. Your predecessor had to cut dividends by 2/3 during 2020 due to a decrease in demand during the pandemic. The demand of oil and gas is predicted to go down as of 2029, according to the IEA. Therefore, we are likely to end up in the same situation of a decline in demand and low oil price. You indicated that you can maintain this with an oil price of $40 a barrel. My question is, if the oil price falls below $40 a barrel for an extended period, will Shell maintain its current dividend payout?
Okay, well, thank you, Rosa, for your question. I will pass it to the CEO, who might want to discuss with his CFO about that. But I should just say something, that dividend policy is a board matter, and we represent you as shareholders, as a board, to make decision choices. But at the recent Capital Markets Day, you're right, that Sinead and Wales said that down to $40 a barrel, we can secure the current progressive dividend. But I don't know if there's anything more you want to add about the longevity of that or otherwise.
Yeah, I think a few points. Firstly, what is clear is that the world ahead of us is becoming more uncertain. We've seen that with the volatility, both geopolitical as well as economic volatility, some of it tariff-induced and others. What we are trying to build is the best version of this company. This is what we have been focused on a company that is able to have the balance sheet that we enjoy today, one of the strongest that we've had in a very long time, in close to a decade, that we are able to continue to take out wastefulization, reduce our costs, continue to be more disciplined in our capital investment, and that is all to build that strength, that resilience for what will inevitably be cycles that we will go through the transition. I would caution once again taking an IEA 2029 view as definitively as the question was framed. I only wish I knew what oil prices were tomorrow, let alone what they're going to be in 2029. The reality is these are incredibly dynamic markets with multiple different factors at play. When it comes to dividend, the reason we have given you the $40 break even is to give you a sense of the resilience of the company. You will, of course, hopefully understand that we cannot at this stage give guarantees or anything around the future, but I think suffice it to say that the board has been very clear around their expectation of us as management, that we will continue to improve the fundamentals of the company so we build real resilience for as long of a period as possible, and that is something which we are absolutely adamant that we are going to do.
My name is Tarek Bouhouch and I work indeed for Follow This. According to all IEA scenarios, oil and gas demand begins to decline by 2029, even under the STEPS scenario, which leads to a catastrophic plus 2.4 degrees Celsius warming by the end of the century. LNG markets are projected to face oversupply soon, and overall fossil fuel demand is set to fall. Therefore, investing in new oil and gas resources is not only harmful to the climate, but now increasingly appears to pose a direct financial risk to the company itself. Given this outlook, can Shell pursue new oil and gas projects in a shrinking market without ending up with stranded assets?
I think we've probably dealt with a lot of those points already, but maybe I'll just repeat a few things. I would just point out to all shareholders that the IEA is one forecasting tool. It's one particular view of the world. It does, in my view, include a lot of conditional commitments made by governments and others that if they weren't to eventuate, and we're seeing some of the weakening that right now, then some of the forecasts they make would not be as compelling. But at Shell, we look at all forecasts. We look at our own forecasts, at other things. We use scenario planning. And I think we've explained we see a phase of continuing growth, particularly in the use of gas, and especially in LNG, that we think it's appropriate to invest in. I would just make one other point. There is a danger in assuming that all oil and all gas are equal in carbon terms. That is not the case. It is possible to bring on new projects in both areas which have a lower carbon footprint than the current supply, or certainly the high end of current supply. And in doing that, if demand moves towards those projects, we will actually contribute to a form of decarbonisation. So there are oil and gas value chains which have a big carbon footprint and those which have a much lesser carbon footprint. And that's why there is still scope for competition in this area, as well as meeting the overall demand. Emil would like to come in on.
Thank you, Chair. Thank you for the question. 2 points just to add to what the Chair said, because there are a couple of elements I think that you refer to. We very much hope that the market for low carbon products grows. We have invested $20 billion of capital employed today is in low carbon. Everything from the investment we're making in Rotterdam in green hydrogen, the biggest investment in Europe, the investment we've made in biogas in Denmark with energy. We are the largest distributor of biofuels, and you heard me earlier talking about sustainable aviation fuels. We're the second largest EV charging platform after Tesla. We've put significant investment. So it is in our interest, on behalf of the shareholders, to see that market grow. We very much want to see that. There's a second part of your question around financial risk. I would just encourage our shareholders to look at a part of our annual report where we really offer you stress testing of our portfolio against different oil price, gas price conditions, demand conditions, and the like, including, by the way, for LNG, where we will hope to be able to add a bit more over the coming few months as promised. But in short, the majority of the value of the assets that we have, the majority of that MPV is realized before 2040. So this is a very resilient investment strategy that we are offering our shareholders, one that allows you to be able to have confidence in our ability to return as these markets, these low carbon markets develop, and hopefully with our $20 billion we've invested, we can demonstrate to you that we have the right to be able to continue to invest and grow in that space.
I'm sorry, I need to react on this, because if I follow Carbon Tracker's analysis of your company, there is a considerable share of your investments that are seriously at risk of being stranded. And I really hope that it is not, these decisions are not made because you believe your tenure will end before the fallout of these decisions is getting felt by the last holders of the company, your shareholders. I really hope it's not because of that.
My advice is Carbon Tracker has external data and has its own assumptions. Trust the disclosures which we are legally bound to do, with auditors that are able to then confirm what we're saying. This is a company that has been around for over 125 years based on the institutions that we have built. So I have high confidence in our ability to be able to match what we have said. But thank you for the question.
Thank you.
Thank you.